All right, we're live. What's up, Facebook, YouTube, and LinkedIn? What I'm going to do today is just a quick lesson. We're going to talk about a big pet peeve of mine and a myth that I used to propagate. So I'm going to throw my own self under the bus, but that you need to understand if you're investing. Most people will ask me, and I don't give investment advice. This is for educational purposes only. But I want you got to understand it's hard to win a game you don't know the rules. All right. And so this video is going to talk about the quote unquote miracle of compound interest. And because what'll happen is a lot of people, uh, a lot of it, there's organizations that, are really big into the selling of mutual funds. And what they do is they'll talk about the miracle, quote unquote, of compound interest. And what they'll do is they will, let me see if I can pull this up. Uh, Let me show you this. There we go. Let's share. What they'll do is they will show what we call the rule of 72, right? So nice to do this. This is actually one of my favorite conversations. And I would show people, listen, here's how money works, okay? And so if you take your interest rate and you divide it into 72, it'll tell you how long it'll take for your money to double. So then where it comes from is money growing at 1% doubles every 72 years. So if you've got money earning 1%, it'll take, if you got $1,000, it'll be 72 years before your $1,000 is worth $2,000. And so now if you take that and you divide that into 72, it'll tell you about how long it'll take your money to double. Okay. So look at six on the board here, 6%, your money will double every 12 years. At 12%, your money will double every 6 years. At 3%, it will double every 24. Right. And so you see here 4, 6, 8. And what I used to show, so at 4%, your money will double, right? 39, 18 years. So a better way to look at that, this is the real way you should look at it, is if inflation is 4%, your money needs to double those year. If inflation is 6%, which is probably a truer number, then you're losing purchasing. Your money has to double every 12 years just to buy the exact same amount of groceries as it buys today. That's a better way to look at it. What happens is people conflate this to say, well, and those are all on the Instagram. You can't see my screen, so you have to go to Facebook and find this and find what I'm showing up. But Facebook or LinkedIn or YouTube is where we're broadcasting. And so what happens is if you look at that people look at that and go, okay. And so now what happens is people will take that myth or that right there, and then they'll make the leap to say, well, okay, my 401k says I did 9.5%, or my prospectus says this fund has averaged. You look in the magazine or something, and the fund has averaged, you know, or the market is average 11.7% or whatever like that. Averages don't mean anything. If I have time, I'm gonna do another video. I have another video out there. I may do a new one, actual versus average, because averages doesn't mean anything. Average is not compounding. Okay. So when you see this is not what's happening. This is math. This is not money. Okay. So what people will do is, I'm taking this from an article Kyle Christensen wrote, a business partner, a good friend of mine, who wrote the book Principles-Based Planning. I'm also a national trainer for that company. And so he posted this on LinkedIn, and I taught it I do a Saturday class for our clients. So I taught this there, and I said, this will be a good something to put out there. So what happens is, here's the title of the article: Stocks Don't Compound Interest, and neither do cows. Okay, I need a picture of cows. He's from out west. So he lives in Texas. So maybe that's where the cow thing comes from. And but what happens is, and neither do cows, right? And so here is I'm going to I'm going to read the article actually. And so what happens is financial advisors are constantly using compound interest calculators, or the time value of money, to project and predict future values for their clients. The problem, so when you see the rule of 72, where people show, all right, here's how money doubles, and they'll throw down a mutual fund prospectus and they say, all right, here's, you make the leap. Now, how do I know this? Because I used to be a registered rep and I did the same damn thing. Okay. Because that's what I was trained on how to sell it, and I thought that was the way you did it. But I've talked to a lot of registered reps. As you watch this may be news to you. The problem with that is that stocks, bonds, mutual funds, ETFs don't compound. Okay, they don't compound interest. No investment compounds interest. Okay, and so this actually does come to a shock of most people in the financial services industry. And what they do is they become defensive. But before you do the same, consider what compounding actually means. Okay, and so compounding is so let's say you have $100. You put $100 into an account that pays 1% a year in interest. So at the end of the year, money doubling upon the money, doubling upon the money. So if you're getting 1%, that means you have $101. And in the second year, your balance will be 102.01. By the end of the third year, it'll be 103.01. So that's compounding interest. What investments do that? Investments don't do that. So the only thing that compounds is savings accounts, CDs. Oh, you guessed it, cash value life insurance. We teach infinite banking here. So, you've got to have things that, now I'm not saying not invest. I'm just saying, you need to understand how they work. Okay. All I try to do is teach people how money works, right? So stocks don't compound interest. So watch this. Hopefully I'm going to switch to videos here. So we talk about that in terms of the yellow tank, investing, and the green tank is your safe money, And so what people do, the first rule of wealth is you've got to do what? You got to pay yourself first, save, and then from your savings, you look for places to deploy your capital. But what equities do, and there's nothing wrong with them, you know what they do? They appreciate and they depreciate. They go up, they go down. And the way you figure out what your investment's worth is you look at the net asset value. You look how many shares you have. You look at the net asset value by the end of the day. That's what your fund is worth. That's not compounding, okay? And see, so the value of a cow or cattle depreciates and appreciates. The value of a house appreciates and depreciates. The value of gold and silver appreciates and depreciates. Actually, I probably would argue with that, because gold is, right. So the dollar is fluctuating. The way I look at gold is constant. Because gold has been money for the same amount. An ounce of gold buys the same amount that it did 2,000 years ago. So it's the dollar that's fluctuating, not gold. But anyway, that's an aside. And so, but what about them? They don't. All those things go up and down in value. And if a company, what about dividends, right? In a stock, they don't compound. I'm going to let my money compound. I'm just going to have the dividends paid out. That's a one-time payment, quarterly or annually, and it doesn't compound. And so there isn't any guarantee you'll have a dividend next year. So what if you reinvest the dividends? Okay, then you're buying more shares of the stock. That's not compounding. Okay. And so that's, you just got to understand what's working, because what happens is people lead you to believe, oh, I got my fund, and you hear these magical 12% mutual funds a certain financial entertainer talks about, but that's not how it works. There's no such thing as a miracle. I've had people on my show that was a miracle compound interest and they loved equities, but hey, and I didn't want to call this person out because he's a guest on the show, but I was like, hello, stocks don't compound. Okay. So, I love to see my money compounding. Well, they don't compound. Okay. Not like that. You can get a rate of return, which is saying, hey, at this point in time, I started here, and at this point in time, it was up here. And if I work backwards, I had a rate of return of Y. That's what equities do. Okay. And so what happens is people use, and the people in the financial world, that's why I don't like typical financial planning. Because see, if it was a science, nobody would lose money. And so it's focused on time times rate times dollar. It's the whole way that financial planning is. I'm gonna do another video on that. It's called flawed, right? Is the whole, you can't get to the right solution when the premise is wrong. Okay, that it's all about accumulation, and some point in time that you'll have this amount of money, you can live off that for the next 35 years based upon nothing in this equation is stable, right? And so, what people do is they use calculators to kind of extrapolate. Oh, they'll say like, what's your number? And you need this. And if you need to average this, and you'll have like $2 million and you'll live happily ever after. And, an economist and mentor that I knew, Kyle, says the only thing right about projections and illustration of future values is that they're all wrong. In fact, they're wrong. Even financial plans are wrong. By the time you print it out and the ink is dry, it's already off. Okay, it's just a moment in time. And so understanding this truth source of, it demolishes the entire use of the phrase the miracle of compound interest. Supposedly Einstein, I don't think he said it, and as it relates to investments, it's just not applicable. Okay, compound interest calculators therefore are generally used as a marketing tool to sell investments, but they are not real predictors of what's going on and what's going to happen, and they generally are a bad way to choose an investment. Calculations and projections are not a good substitute for real knowledge and an investment. So, because remember, what are our 3 rules of investing? Invest in your expertise. What do you know? Okay, you are your number one asset. What do you work on? Your mindset, your skill set, and your network. Invest in what you can influence the outcome of. Okay, does it cash flow? Can your knowledge, your specialized knowledge, make it perform better? I.e., your business. I would give you, if you're a trader, I would say that your specialized knowledge will allow you to make money. Real estate, obviously, and you've got to see, investing is not about buying something, it's about becoming something. Okay, which means that it's become, then do, then have. Everybody wants to take out the becoming, and people have you brainwashed into, well, just give it to us. Most of the financial world's basic marketing approach is give your money to us, because you don't have the time to train and personally manage your own money. Give it to us. And that may be true, but that's not a good plan. And so you need to educate yourself. I'm a financial educator. I want to teach you how money works, because see, what you know today will determine where you'll be at 5 to 10 years from now. And your economic situation is a matter of choice, not chance. So, hey, this is just a Practical Wealth Live Minute. Check out the Practical Wealth Show. Subscribe to our YouTube channel. And hey, if we can help you, if you like a free report. So we teach velocity of money versus the accumulation theory. And so if you'd like a free report, if you'll text Be the Bank to 55444, we will send you out a really free, interesting report. And we may give you an opportunity to, if you want to get on our calendar and talk about some of this stuff, we'd be happy to have a talk with you. Go out there and make it a profitable day, everybody.